Ladies and gentlemen, good day and welcome to Diffusion Engineers Limited Q1 FY27 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your dashboard phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers Limited. Thank you, and over to you, sir.
Good afternoon, everyone, and welcome to Diffusion Engineers earnings conference call for the first quarter ended 30th June 2026. We are delighted to have you join us today. I'm joined by Mr. Abhishek Mehta, our CFO, Ms. Chanchal Jaiswal, Company Secretary and Compliance Officer, and our investor relations team from Adfactors PR. The investor presentation and media release have been uploaded to the stock exchanges and are available on our website. I will share some key highlights, recent developments, and our outlook for the future before we open the floor for questions. Let me begin with broader industry environment. We continue to see a favorable structural environment for the sectors we serve in. India's core industry maintained strong momentum during Q1 FY27. Provisional industrial data indicates finished steel production has increased by approximately 6% annually, and it has further grown to 8.3% during April to June 26 quarter. The cement sector also remains bullish. Industry expectations point towards approximately 7 to 8% volume growth in FY27, supported by infrastructure spending, housing, and urbanization. These trends are relevant for us because cement, steel, power, mining, and other process industries represent important end markets for our products. We are also seeing a continued emphasis on infrastructure manufacturing investment in India. The FY27 Union Budget provides for substantial capital expenditure in the railway sector, with total railways expenditure including extra budgetary resources of approximately 2.9 lakh crore. This broader investment cycle supports opportunities across engineering, wear protection, maintenance, and specialized and precision manufacturing. At the same time, we remain mindful of global uncertainties, commodity price movements, freight costs, and geopolitical developments. Steel, ferroalloys, and other specialty metals remain important components of our raw material basket. Our approach is therefore to maintain pricing discipline, closely manage procurement, and increasingly use contractual mechanisms that provide appropriate protection against raw material volatility. Moving to our order position, we remain encouraged by the momentum we are seeing across all the core business areas. As of 30th June 2026, our consolidated order book stands at 209 crores compared with 174 crores in March 2026, representing a sequential increase of approximately 20.4%. The order book is also becoming increasingly diversified. Our heavy engineering order book stands at 159 crores, wear plates and wear parts at 26.42 crores, and welding consumables at 24.22 crores. This particularly strong increase in welding consumables order book is encouraging because it reflects healthy demand across our recurring and maintenance-oriented customer base. We believe our order book provides good visibility for the coming quarters. Importantly, our business is not solely dependent on large project orders. A significant portion of our business is linked to maintenance, replacement, and reconditioning requirements across the installed industrial base. During the period, we secured multiple significant domestic orders across cement, defense, and power sectors, including an order worth approximately 9.88 crores for the supply of VRMs and separator parts for the cement industry, a 8.16 crore order for the supply and maintenance of roller press rolls for cement industry, a 10.63 crore order for supply of roller assemblies and retrofitting of shafts for the cement industry, 7.49 crore order for supply of flux core wire for defense, and 26.31 crore order for the supply of RAPH rotor assembly for power industry. These orders, aggregating to approximately 62.47 crores, further strengthen the company's order pipeline and reinforces its presence across key industrial sector. This creates a relatively resilient demand profile because customers need to maintain equipment availability and minimize unplanned breakdown even when the broader capital expenditure cycle may moderate. Our experience has also shown that customers are increasingly moving from purchasing individual welding consumables towards ready-to-fit parts, specialized engineering solutions, and total solutions. This structural shift plays directly to our strengths because we have progressively moved up the value chain from consumables to wear plates, wear parts, reconditioning, and heavy engineering. One of the most important developments for us is to progress on our capacity expansion program. We are executing a roughly 100 crore expansion program, which is designed to materially increase our manufacturing capacity across electrodes, wear plates, and heavy engineering. Our heavy engineering capacity has been expanded from 9,000 metric ton to 18,000 metric ton, while our electrode capacity has also been expanded, supported by a new strip slitting capability that will strengthen our backward integration. The expanded manufacturing infrastructure will allow us to cater to larger and more complex requirements across our customers' sectors. Our new manufacturing infrastructure at Nagpur is therefore not simply an incremental capacity addition. It is an important step in strengthening our integrated manufacturing model and increasing our ability to capture larger customer requirements. As these capacities ramp up, our focus will remain on a disciplined commissioning process, maintaining product quality and progressive improvement of capacity utilization. We have historically delivered a strong growth trajectory even when operating at relatively high utilization levels. Our 5-year consolidated revenue CAGR has been approximately 21%, and the new capacity gives us significantly greater headroom for the next phase of growth. Our strategic direction remains clear. Our objective is to provide specialized wear protection and engineering solutions that help customers improve asset life, reduce downtime, and enhance operational efficiency. This is why our forward integration from electrodes and flux core wires into wear plates, wear parts, and heavy engineering is strategically important. Our own consumables and metallurgical capabilities are increasingly being used within our downstream products, allowing us to create an integrated value chain. We believe this model gives us several advantages: better customer engagement, higher value applications, greater customization, and opportunities to participate in a larger portion of customers' maintenance and engineering requirement. Our R&D capabilities are also an important part of the strategy. We have a DSIR-approved R&D facility supported by testing and laboratory infrastructure, which enables us to undertake product development, process refinement, and raw material analysis. Focus on margins and operational efficiency. As we enter the next phase of capacity expansion, our focus will remain equally strong on profitability. The first priority is to improve utilization of the expanded facilities and absorb fixed cost over larger revenue base. The second is to increase backward integration, particularly in areas of raw material processing and strip processing. The third is to improve our product mix by increasing the contribution from wear parts, heavy engineering, and specialized consumables and engineering services. We see the potential for gradual margin improvement as capacity ramps up, provided that raw material conditions remain reasonably stable and we maintain execution discipline. International expansion remains another important pillar of our strategy. We currently serve across 35 plus countries, with a presence across Middle East, Far East, Southeast Asia, Africa, Eastern Europe, Russia, and North America. Our objective is to build international business not merely through product exports, but increasingly through specialized engineering and service capabilities. The UAE and Turkey initiatives provides us with an opportunity to build a stronger regional presence over time. We have also secured important approvals and strengthened our ability to participate in Middle Eastern industrial and oil and gas ecosystem. We see international markets as a meaningful medium-term growth opportunity, particularly where customers value specialized wear protection, engineering expertise, and on-site service capabilities. New growth opportunities. Beyond our traditional end markets, we are selectively building capabilities in sectors that can provide long-term growth opportunities. Railways is one such area. We are progressing through the development and qualification process for opportunities in the Vande Bharat ecosystem. While we remain conscious that such programs have a longer gestation cycle, we believe that becoming an approved supplier can create meaningful opportunity over the medium term. Similarly, our participation in the defense ecosystem is a strategic initiative where our engineering and manufacturing capabilities can be leveraged. These opportunities are not being pursued at the expense of our core business. Rather, we see them as extensions of our capabilities that we have developed over 4 decades. Looking ahead, I remain confident about the medium to long-term growth prospects of Diffusion Engineers. We have three important growth engines. First, our core maintenance and wear protection business, which provides recurring demand from a large installed industrial base. Second, the newly added manufacturing capacity, which provides us with the ability to execute larger orders and participate in more complex applications. And third, our new growth opportunities across international markets, railways, and defense, requiring a specialized engineering applications. Our immediate priorities for FY27 will be to execute the existing order book efficiently, ramp up new capacities, and maintain our quality standards, deepen relationships with existing customers, and expand our presence in new markets. We will remain disciplined in our approach to working capital, raw material procurement, and capital allocation. The broader opportunity is significant, but our approach will remain calibrated. We want to grow in areas where we have a clear technological, manufacturing, and customer relationship advantage. I now invite our CFO, Mr. Mehta, to take you through Q1 FY27 financial performance.
Thank you, Prashant sir. I will now walk you through our standalone and consolidated financial performance for Q1 FY27. First, I will start with consolidated performance highlights for quarter ended 30th June 2026. Revenue from operations was rupees 1101.08 million in Q1 FY27 as against rupees 806.65 million in Q1 FY26, YOY increase of 36.5% on the back of strong demand across the core industrial segment, higher execution levels, and healthy order book. EBITDA, excluding other income, was at 141.54 million in Q1 FY27 as against 105.81 million in Q1 FY26, increase of 33.76% YOY, supported by operating leverage from higher volumes, improved execution efficiency, and better absorption of fixed costs. EBITDA margin, excluding other income for the quarter, at 12.85%. EBITDA margin moderated slightly to 12.85% from 13.12%, primarily due to higher raw material and employee costs as a percentage of sales. Profit after tax stood at 166.77 million in Q1 FY27 compared to 122.64 million in Q1 FY26, YOY increase of 35.98%, reflecting stronger operating performance and higher share of profits from associates, despite the moderation in other income and margin pressure. Now I will take you through standalone performance highlights for the quarter ended 30th June 2026. Revenue from operation was 959.13 million in Q1 FY27 as against 733.72 million in Q1 FY26, increase of 30.72% YOY, due to healthy demand across core industrial segments, improved execution capabilities, and strong order book. EBITDA, excluding other income, was at 121.54 million in Q1 FY27 as against 86.54 million in Q1 FY26, increase of 40.44% YOY on account of higher operating volumes, better execution, supported by operating leverage. EBITDA margin, excluding other income, stood at 12.67%, driven by improved absorption of fixed costs and operating efficiency. Profit after tax stood at 99.79 million in Q1 FY27 compared to 142.04 million in Q1 FY26, primarily due to dividend from our subsidiary, 100% wholly owned subsidiary of around 5 crore in Q1 FY26. With that, I now open the floor to any questions you may have. Thank you for the time and continued support.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rahul Maheshwari from Ambit Investment Advisors. Please go ahead.
Good afternoon. Congratulations, Prashant and Abhishek, for the excellent execution. Couple of questions. First, if it is possible, can you give what has driven the growth on the four segments in terms of consumables, wear parts, heavy engineering, and trading? What is the growth for each segment that has happened? And second, how much is the domestic versus the exports growth that has been taking place? And the third question is on the product pipeline. Any new product pipeline apart from the rotator, separator, or shredder has been added into the existing pipeline? Yes.
So we understood there are three questions that you've asked. One is the growth in exports and domestic. Second, you've asked about any new product development pipeline. And I think the third question is regarding
segments growth. If it is possible, it will be very helpful.
So, see, overall growth has been 30+%, and we have seen growth in all the three segments of the business, which is consumables, wear plates and parts, and heavy engineering. The reason why this growth has come is because we entered the quarter with a significantly higher order book. So typically, historically, at the end of the year, the order book used to shrink because, we used to have very high sales in Q4 of the preceding year. But this year, in spite of having high sales in the Q4 of preceding year, our starting order book was also significant. So therefore, our Q1 results have been much better than historical Q1 results. And we have seen this growth coming across the three aspects of the business, which is, as I mentioned, consumables, wear plates, and heavy engineering. We have seen growth happening in domestic more than exports in Q1 specifically, because last year Q1 for exports, we had some larger orders which were executed in Q1, which did not replicate in this year, but we are seeing the ramp up of export sales happening in the subsequent quarters. So a majority of this growth has come from domestic sales. You have to bear in mind that the execution cycle follows the order intake cycle and also depends on the order mix, because some orders are executed with shorter lead times and some orders need longer lead times. Now, regarding your third question on product pipeline development, so the product pipelines that we've been discussing takes few months to develop, and after development it takes similar amount of time, probably few quarters, to sort of promote in the market, to explain to the customers our value proposition and then sell to the customers. So right now we have worked on 4 or 5 new such products, and they are right now we are in the process of promoting them in the end customer industry, and we will start seeing some results coming out of them in this quarter and subsequent quarters.
Prashant, just if I ask a follow-up, any top 2-3 products where the prospects is too high and you can witness the same thing in FY27 for the entire year, irrespective of timeline?
So we are working on VRM rollers. That has got a very high mill population. We've already got some initial orders from end customers, and we expect to replicate that. The steel mill roller business is ongoing. So whatever rollers we had supplied before have completed their life cycles, and we have had very good feedback from customers. So now our focus is to replicate that across industry. That's also a very high volume business. And there are further more such high volume products and wear parts which are needed in the industry, on which we are focusing, where they are constantly wearing out and they are used as consumables in the end customer industry.
Yeah, sir. That's very helpful, and best wishes to the entire team. Thank you.
Thank you. A reminder to all the participants, you may press star and one to ask a question. The next question is from the line of Kunal Mehta from InCred Equities. Please go ahead.
Hi, sir. Very good afternoon, and congrats on the good set of numbers. My first question is on the raw material price volatility. We saw that in Q4 and Q1, the gross margin had compressed because I think China controlled the price and the supply of tungsten and other rare earth elements. So are we seeing any kind of normalization in these prices, some stability, or still is it very volatile?
So, of course, because of the reason that you mentioned and also because of the war in Middle East, there was an immediate impact on the raw material prices and energy costs, which was transferred to us. And typically, it takes some time for us to sort of absorb it and then transfer it to our customers, especially for orders which we have already clocked in and which are in advanced stages of execution. We can't go back to the customer and ask midway for price hikes. So that is why you've seen in Q4 last year and Q1 this year that there has been some gross margin contraction. But we've been able to sort of absorb it primarily due to higher revenue and higher level of execution. So the fixed costs have got spread over higher revenue base, because of which the increase in or the reduction in gross margin is not so significant. Now, regarding volatility, of course, there has been some stabilization. The raw material prices remain high for some of these key raw materials and ferroalloys. But at least one good thing that has happened is that the volatility is not to the same extent what we noticed it in Q1. So price levels remain high, but there is some sort of stabilization, and also there has been acceptance of higher price levels from the customer. So it took us a lot of time to explain to the customers the situation that we are facing in terms of raw material pricing. And now customer has accepted it and has started accounting for their cost also with higher price levels.
Okay. Any percentage, if you can give, how much has been the impact of that? How much, like maybe 20%-30%, or has the price gone still above that, the raw material price?
No, so we can't give a generalized figure because we have a variety of raw materials. So, for example, steel has gone up by roughly around 20-odd%. Some of the ferroalloys like tungsten and all have gone up by a few 100%. So it's a wide range. So I can't give you a single figure for all raw materials, but that is basically reflected in our gross margin contraction, which is roughly around by
roughly around 1.5% in the gross margin contraction.
Yeah.
Okay. Also, my second question would be, out of the 210 crore of order book currently outstanding, how much is executable in FY27? Give a range.
So I think it would be fair to say more than 80% of it is execute as we speak right now. More than 80% of it is executable in this year. And also we are now seeing renewed sort of requests from customers where they are asking us to prepone some deliveries. So some of the items which were sort of scheduled for next year, we are getting requests from customers that they want faster delivery, so which is a good sign. Because they want to place orders for subsequent year. They are seeing increased demand, especially in the power sector, for subsequent year.
Okay. And do we get any advances for this? How is the payment terms for the heavy engineering products?
So the faster we execute, of course, the faster we'll get paid. So typically the payment terms are, the advances range anywhere between 10 to 20%, 60%, depending on the advance, then we'll get around 80 to 70% post dispatch, and then balance after some sort of warranty documentation. So the faster we execute, the faster we'll get paid from the customer. Also, our capacities will open up for future requirements, which the customer is now seeing a strong pipeline, and he's asking us to execute faster, and that's why they're requesting for preponement, because they're seeing a lot of orders coming in for the subsequent financial years.
And when will the new capacity commission? In August itself, or still some delay?
So I'm happy to inform you that in a phase-wise manner, we've started utilizing a new factory shop floor area. We've already sort of started utilizing the new capacity, not in a 100% manner right now, but in a phase-wise manner. We have already started using the new constructed area that we have set up, and we can say that the capacity, the new facility sort of started coming live in a phase-wise manner.
Okay. And in heavy engineering, how much is the bought out component part? How much percentage of components are bought out? For example, in a vertical roller machine or high pressure grinding machine, how much is the percentage of bought out components that
So only the forgings and the castings are bought out. The rest of the fabricated parts we make ourselves. So any heavy engineering part in which there are some forgings and castings, because we're not a forging or a casting or a foundry we're not a foundry or a forging company. So those things are bought out. Rest all of the things are pretty much done in-house by us.
So the motor and everything is done by us only?
No, we don't supply motor and control panels, because that is not our area of expertise and not our product offering. We only supply the manufactured equipments or fabricated equipments.
Okay. And I think in the first quarter we saw a 4.5 crore share of profit from associates or JV. Is this from LSN Diffusion or
it is from LSN? It is from LSN Diffusion.
But this is quite a huge. So I mean, can this be considered as something like an anomaly, or this is something that would be going ahead a steady state share of profit?
So typically, if you refer historically our numbers, the contribution used to be anywhere between 1 to 2 CR.
Yes.
Of course, 4.4 is a substantial increase that has come in for this particular quarter. I think 1 to 2 CR is what we can keep expecting. 4 is sort of, we can consider +2 to be an extra, which is coming for this particular quarter.
Okay. And any update on the UAE and the Turkey facility? How will we be ramping that up eventually?
So Turkey is already up and running. Not the facility, but the business is up and running. Our revenue from Turkey has started increasing. Also, we are not in the red there because initial startup phase, of course, costs are high and revenue is low. So we've been able to come out of the red in Turkey. UAE facility is already available to us now for manufacturing and carrying out services for, and that has already been sort of set up and it's up and running. So we will start seeing revenue coming in from Q2 onwards from UAE facility also.
Okay. I have more questions, but I'll fall back in the queue.
Okay.
Thank you. A reminder to all the participants, you may press star and one to ask question. The next question is from the line of Rohan Mehta, an individual investor. Please go ahead.
Yeah, good afternoon, and thank you for the opportunity. Sir, if you could just touch upon our R&D related initiatives. If there is a budget for R&D as a % of revenue and the product that might be under development pipeline, if you could shed some light on that.
So the kind of industry where we are in, we are always constantly developing new solutions to counter wear and tear in core industrial sector. And equipment sizes have significantly increased in all these end customer industries. For example, steel, cement. So typically, 10-15 years ago, a typical cement plant used to be 5,000-6,000 tons per day kind of capacity, which is now become very normal to set up. New plants are normally typically 10,000-12,000 tons per day capacity. So when these equipment sort of break down, the production loss is even higher and more significant. And because these equipments are now much bigger in size, the wear conditions or the operating conditions are even more severe. The stress loads, the working loads. So it's a constant sort of feedback that we keep getting from the customers, and we have a team of two dedicated specialist metallurgical engineers who've completed their doctorate, who are constantly taking this feedback and understanding the kind of problems that customers are facing and trying to develop new solutions. We spend close to 1% of our revenue in R&D, and this is done in through many avenues. So it's not just directly sort of only development of product, but also through trying out new solutions for the customers, sending them in the field for trials, and subsequently there are costs that we incur when we try some new products and we do some new trials. If things don't work as per expectations, then we have to again sort of condition them or repair those items to meet the expected lifetimes. So all put together, it's a constant sort of back and forth which keeps happening between us and the customers. The customers are also very demanding in terms of their expectations of equipment lifetimes because of the reasons I just mentioned. So it's a constant loop where we operate in, and we are further strengthening our team with more analytical equipment so that we can develop our products and solutions faster. Does that answer your question?
The participant left the queue. We'll move to the next.
Okay.
The next question is from the line of Shravan Modi from Syndicate. Please go ahead.
Good afternoon, sir. Thank you so much for the opportunity. So my question is, which overseas subsidiary or associates are currently contributing most to our profitability margins?
So the maximum contribution is coming from Philippines right now, and Singapore.
Right. So this is increased to 98 in FY26. Can I know what actually caused the increase in this many days?
Sorry, your voice cracked, so we are not able to hear you. If you can just repeat.
So this is increased to 98.
So your voice is not clear properly.
Yeah, I'll join the queue again.
Okay. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead. Yes, Mr. Sunil, go with the question, please.
Sorry. My question relates to, first of all, congratulations for such a good growth. So my question relates to the order booking pipeline, how you are looking at it, and specifically Q2 is generally a strong quarter for you. So how you see maintenance work from cement industry in this quarter?
So order book as we speak is, as we mentioned, is around 209 crores at the end of Q1, and we still see significant sort of traction and interest in our products and services. So we expect the order book to only grow from here, in spite of the fact that our execution is also growing. So we expect the order book to remain same or even get better as we move forward. And Q2 is, as you rightly said, is typically stronger because this is a period where a lot of maintenance activities happen in the industry because of the rainy season. So we're expecting continued growth in Q2 also, based on increased maintenance activities in the industry and also a strong order book. We expect to maintain significant similar growth levels in Q2 also.
That's great. So second question relate to, we had seen when welding consumable order booking has increased. So any specific reason for that?
So sir, what is happening is some of the customers are consolidating their requirements because of their increased activity and placing order on a sort of a yearly basis. So there are some staggered deliveries where customers have consolidated their requirements and clubbed their requirements and given us a complete order. So that is why the order book in consumables have also gone up. This is one reason, and second is of course the sales are increasing in consumables, because of which the order book has also gone up.
So there is no one-off which may be getting, because these are short cycles, so can get revenue faster in Q2. Not like that.
No, there's no one-off case where, we've had a rainfall sort of windfall order, which cannot be repeated again. This is happening because of, efforts of last few quarters where, our products are becoming part of their manufacturing value chain, and they are becoming key raw materials or consumables for their manufacturing processes.
Last question relating to defense. So we are supplying consumables to the defense sector. Apart from that, any progress on any other product which we can get qualified in coming period?
So apart from the consumables, sir, we've not been able to break through yet, but our efforts are on to sort of have a similar approach that we have used in steel, cement, and other core industrial industries. So rather than just getting into supply of consumables.
Hello? We can hear you, sir.
Hello, can you hear us, sir?
Yeah, we can. Hello?
Yes, sir, we can hear you. Go with the question.
So I think there was some connection issue. I'll just repeat my answer. So our approach is to continue having the same strategy where we do more and more for the same customer. We've of course been trying to get into to move up the value chain in defense sector in terms of manufacturing sub-assemblies and not just supply welding consumables. But of course that requires competitive bidding where we've not been successful yet. But apart from this, what we are doing in Tejaroop, that is progressing well. Tejaroop is a company in which we invested and took 10% stake, and they are developing a prototype for Vishwarat, which is very short air defense system. So we expect that is moving in the right direction, and hopefully once the prototype is approved, the manufacturing will bring in more revenue for us.
Okay. So any percentage you can assign to defense revenue in the overall revenue, or it's very small?
This is right now approximately anywhere between 1.5 to 2% as of now.
Okay, great. Okay, thank you very much, sir, and all the best for the coming quarter.
Thank you.
Thank you. The next question is from the line of Pia Jain from Sapphire Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Hopefully, I'm audible.
Yes.
So you said that you've started utilizing the new capacity already, and with such a good order book, how do we look at FY27 and 28 in terms of revenue and margin?
So we are expecting to grow at around 20% in FY27-28 and continuously for next 3-4 years, and try to expect ourselves to double in next 3 years. That is one thing. And in terms of the margins, we expect EBITDA to grow by around 100 to 200 basis points in FY27 and 28. By FY27 and 28 level.
Okay, sir. And any investments that we are planning for?
Any investment in new capex is what we're talking about?
Yes, sir.
So we may look for some investments or new capex, do some backward integration more, but still it's in pipeline. Nothing is finalized as of now.
So we are in the process of finishing our earlier capex, and our intention is that once we reach again close to 70-80% utilization of the newly installed capacity, we will immediately start expanding again and not wait for longer duration, because historically we have noticed that we should expand much faster and not wait for the utilization levels to reach up to 85% and then expand. So right now it's still on the drawing board, nothing planned completely as of now.
Okay, sir. Understood. Thank you and all the best.
Thanks.
Thank you. The next question is from the line of Ankur Tripathi, an individual investor. Please go ahead. Yes, Mr. Ankur, go with your question, please. As there is no response from the participant, we'll move to the next. The next question is from the line of Ram Singh, an individual investor. Please go ahead.
Hello, am I audible?
Yes, sir.
Sir, what I see is that we had peak margins of 18%, and from 18% now we are around 13% of margin. So are we going to improve from here? How would the margin trajectory be from here? That would be my first question. Secondly, sir, we have grown by 33%, and our guidance is of 20% growth. So are we conservative in terms of revenue guidance? Are we going to have a beat? These are my two questions.
So I'll just try to repeat your question. Question number one is, we had a margin of 18% and why it has fallen to 13%, correct? Are you talking about standalone, if I'm not wrong?
Sir, my question is, now we have come to 13% round, so how the margin trajectory would be from here onwards?
So
Q1 was the bottom or not?
Last year in Q1 FY26, we received a one-time dividend from our Singapore wholly owned subsidiary of around 5 crore, which increased our bottom line in the standalone financials. And if you look at our consolidated financials, our numbers have been improving.
Okay.
And yes, sorry.
This quarter we had margins of EBITDA margins of 13%.
Correct.
So
EBITDA margins.
Do you see them improving from here?
Yes.
So EBITDA margins have shrunk slightly in this quarter because of the volatility of raw material prices and the raw material prices increase, which has happened after the war. As we explained before, that we've been able to pass on these increases to our customer, and now prices are not so volatile. So we expect the EBITDA margins to get back to previous Q1 levels. And as we also indicated before, we expect them to increase by 100 to 200 basis points over the next year and a half.
Noted, sir. Secondly, sir, we have been growing with a faster rate and our guidance was 20%. So are we on a conservative side?
So, sir, we always believe in, overperforming and undercommitting or being realistic. So, of course, we think there is more potential in the business, but we always feel that, we should manage expectations well and, be prudent in terms of what we are indicating.
Okay, sir. Noted. Last time you mentioned that there are certain railway orders which you expect to come. So,
sorry, which orders which are expected to come?
Railway orders.
Yes.
So
we are in the yes. So we are in the process of getting our workshops evaluated. And there is a constant sort of communication happening between us and the authorities in railways. And they are visiting our workshop to approve our workshop so that we can start executing these developmental orders. And we've got some small orders, but not of significant values. We'll be expecting some other tenders to also materialize post the approval of our workshop, after which we will start seeing increase in the revenue coming in from railways. This is for new development items that we are doing for Vande Bharat items, for Vande Bharat trains and for locomotives. But our old business, our incumbent business in railways in terms of points and crossing repairs, and also supplying wear liners for their ballast cleaning machines. All of that is growing, and that continues to exist.
Okay, sir. Sir, we were also L1 in certain orders. So have those orders materialized in Q1, or are we also expecting some orders in Q2?
No, so those orders where we had become L1 or L2, railways inspection authorities are now evaluating our workshop facilities, because these are completely new developmental orders which we've not done before, and only partial quantities will be awarded to us as developmental items, and post our workshop approvals, then these expression of interest or these opportunities will get converted into orders. So right now we've got, I think, 1 or 2 small orders. The rest are under evaluation.
Any timeline, sir? If everything goes well and our workshop is approved, then by end of FY27 we'll be having those orders?
So we expect all of this to get converted into revenue between 9 to 12 months.
Okay, sir. Thank you so much, and best wishes.
Thank you.
Thank you. The next question is from the line of Praneeth from MGA. Please go ahead.
Hello, am I audible?
Yes.
Yes.
Yeah. Thank you so much for the opportunity. My question to the management is, since the IPO, the company has deployed a significant portion of the proceeds towards capacity expansion. Can you quantify how much of the IPO funded capacity is currently operational, and how much revenue and EBITDA we are generating today, and by when you expect that full earning contribution from this investment?
So we are still spending from the IPO money. Recently, just as Mr. Prashant said, that our new capacity has just started in a phased manner. So there is not much contribution in terms of EBITDA and margins from that capacity expansion, which will come in next quarter, start contributing from next quarter, but it will take around 2 to 3 years time to ramp up these capacities. And similarly, another capacity which we have implemented for electrodes, that is also just started in the last quarter of Q4 to FY26. It will also take around 2 to 3 years to ramp up and start giving better EBITDA and operational margins.
Okay. As of December 2025, a substantial portion of the IPO proceeds still remain unutilized, and with the fund largely placed in the fixed deposit. So
Yes.
are those timeline have been changed from whatever were as per the original IPO schedule, and how much is the
Yes.
unutilized balance as of now?
So as of now, somewhat around 67 crores is still unutilized, and we expect that these proceeds will be fully utilized by this year end. But most of the capacity which we wanted to be ready is already done, and only some portion of it is pending, which will be done in next quarter. So we will have some savings from the IPO proceeds, which will utilize for some other purpose with the approvals of the shareholders and other compliances requirement.
Okay, got it. Thank you so much, sir. Thank you.
Thank you. The next follow-up question is from the line of Kunal Mehta from InCred Equities. Please go ahead.
Hi, sir. My question is on the broader accessible market. I think in the presentation we have mentioned that the welding consumables industry in India is about 1.6 billion. From this, what is the addressable market for diffusion, in the specialized welding segment? And even in heavy engineering, we have mentioned 180 billion in India, but I think we are just maybe focused to certain industries. So what is the actual, market that we can service? Because currently we are pretty small. So, what is the actual serviceable market that we can see in this, as well as the new segments that we are going for instance, the railway? How much would be maybe the potential quantum of orders that we can get from Vande Bharat or for Visho-Rad under Tejo? You can throw some light on that.
So as far as consumables are concerned, the entire market is addressable because we manufacture all the consumables in our range, welding consumables. But of course, every company has its own strength and brand recognition. Our brand is recognized with specialty, hard-faced, and MNR consumables. So, addressable market is out there. It depends as a strategy what we are trying to address, which part of the market are we trying to address. In terms of heavy engineering, of course, this is a very, very big market, and sky is the limit here. I think market is not a problem in heavy engineering. It depends on how fast we are able to develop capabilities and profitably grow in the sectors where we operate in. So we are not really looking at it from market sizing point of view, but we are looking at it from our competitive advantage and strength point of view, in terms of which are the areas where we think we can earn higher margins for the same amount of effort that we put in while manufacturing a large industrial component or a large industrial equipment. So that will be my very sort of simple answer to your question. And I think in heavy engineering, getting business is predominantly dependent on the capabilities that we develop, because anyways there's an entry barrier in terms of very few players who can manufacture such large, precise manufactured items. And with the IPO proceeds, we are now further investing in our machining capabilities. So there are very few companies who can do large machine components with precision, which requires precision manufacturing. So it then will boil down to which projects do we want to choose, which can be replicated faster and which can give us higher margin contribution, rather than just focusing on what is the market size and then how do we address this market size.
But in heavy engineering, yeah, I think it answers, but just wanted to understand, we have predominantly been a welding consumable and wear part player, which is which kind of, once the customer procures wear plates or welding consumable for us, every 12 to 24 months they will keep on buying from us, and they will be a customer and the stickiness is very high. But in case of heavy engineering, do we see that same kind of customer behavior or that stickiness, or is it a little different ballgame?
No, we say, so of course 70% of the heavy engineering comes for new project build, 30% comes for spare parts for existing installed base. So of course it is dependent on new brownfield and greenfield expansion happening in the industry. But stickiness in heavy engineering is also very high, because we then become the factories and the manufacturing arms of some of these engineering companies who depend on manufacturers like us to execute their orders. And bear in mind that most of these companies are European or Japanese OEMs who expect very high level of quality and execution discipline in terms of timely deliveries. So once we execute certain projects with them, they get a lot of comfort with our team, our quality levels, our execution discipline, and we become their sort of de facto manufacturing arm. So they then just try to replicate more and more orders with us, and they go forward more aggressively, get more orders from the industry, and then in turn offload these orders on us. So there's a very high amount of stickiness that is there in heavy engineering. Sometimes in consumable business or wear parts business, we still have to sort of competitively bid against our competitors to win these contracts. But in heavy engineering, if we are delivering good quality and doing timely delivery, the stickiness is quite high.
So because over the last 4 years, from around 75 odd crore, our welding business has grown to about 110 odd crore. Whereas heavy engineering, we have grown from around 55 to upwards of 125, 130. So, I mean, we are growing much faster in heavy engineering equipment, and I think, are you trying to imply that this will be the largest share of our revenue going ahead, and welding consumables will remain a smaller part of the revenue mix?
So clearly, heavy engineering, the nature of orders in terms of order sizing and also, you know, in terms of the market as we see, as you yourself mentioned, the market for consumables is 1.6 billion and market for heavy engineering is 180 billion. So, the scope available in heavy engineering is very, very big. And, we are not just focusing on manufacturing equipment or fabrication and selling equipment. We always have a metallurgical angle and an angle of lifetime improvement in the equipment that we manufacture. So we are combining those capabilities and selling these equipments. So clearly, we are moving up the value chain. And I'll give you an example. So previously, we would supply only electrodes or wires to carry out repair on grinding rollers in a cement plant. Now, when I start getting into the business of supplying the complete roller, my order size, my order contribution of a roller will be always be many times over the electrode or the wire that I supply for repair and maintenance because of the sheer volume of the order, right? So obviously, the contribution coming from heavy engineering side in terms of revenue is much higher in comparison to the consumables side. But having said that, the industry is also moving in that direction. Now, industry wants players who are not just, available for carrying out repair and maintenance. They want someone who can supply the equipment or the spare part and then also maintain it over its life cycle. And we are sort of developing this industry and also sort of developing solutions for this requirement of the industry together.
So are you trying to imply that the heavy engineering equipment also has some captive consumption of welding and wear parts also, the revenue in heavy engineering?
So yes, absolutely. Yeah. So a large part, our first preference is to manufacture those heavy engineering items or equipments where there's a significant, or even at least, if not significant, then there is a substantial portion of wear parts or consumables needed to manufacture those items, or special sort of cladding needed to manufacture those items, because that's where our sweet spot is. We can be far more competitive than any of the other heavy engineering manufacturers because we have those capabilities in-house. So that's our sweet spot. Of course, we don't restrict ourselves with that. We also do other items where they may not be a wear part, but our first preference is to focus on such parts. And that drives the sales of our consumables as well as wear parts.
Okay. And on the leasing of heavy equipment model that we have mentioned in our prospectus, what is the current situation of that segment?
We've not been able to sort of break through for newer orders in leasing because we had started this in cement sector with 2 contracts in a leading cement producer with a leading cement producer, but right now they are saying that we are in such aggressive expansion mode and our cost of capital is very low, so we would rather pay upfront and buy and give you a maintenance contract for the leasing period. So they are doing the majority upfront payment and then fixing the maintenance contract for the life cycle period, rather than, leasing it out where they pay us in equal installments over the life cycle of the equipment.
Okay. And what is the top 10 customer concentration in our revenue?
In terms of top 10, would you like to know the industry basically, or?
No. Overall in our revenue of 400 crore, how much do the top 10 customers, or maybe in heavy engineering, if you can give me an idea on that?
Honestly, we don't have that answer ready. Maybe we can
Sure,
check from our ERP and send you a separate reply for that.
Yeah, and in the RHP it was almost 70%.
I think the nature of the business hasn't changed much, and that sort of sounds about right. Anywhere between 60 to 70% is what we expect it to be. But to be able to give you an accurate answer, we would rather check the data and share it with you.
And also, if you all can share the current capacity of the unit 1, because I think after the RHP there is not much mention of how much capacity is there in unit 1, 2, and 3. Or is it same? Have we done any upgrades in unit 1, 2, and 3?
Unit 1, 2, and 3, there is no change in the capacity. Whatever expansion has happened, it's in Unit 4 and Unit 5 only right now.
Okay.
Unit 1, 2, and 3, there is no change in the capacity.
So are we operating at optimal utilization on all three units, and that was kind of a constraint?
We are operating at optimal in Unit 1 and Unit 3. Unit 1 and Unit 2. Unit 3, we are not operating at optimal level because if you see that utilization is around 2% or 3%.
Correct.
So it is still in that level only right now because of the use of the product in our industry.
Okay. And in Unit 4, what is the capacity of flux cord wires?
So that is mainly for in-house consumption, which is used for making wear parts for heavy engineered items.
Okay. So
that is not used for selling to end customers.
So when you say 9,000 metric tons capacity augmentation in heavy engineering, that doesn't include this flux cord wire?
It includes all. It includes heavy engineering, wear plates and wear parts. Heavy engineering, wear plates and flux cord wires.
Which are used in heavy engineered items. So just to clarify, the customer, if he places an order for a large classifier or a separator from us, that will include the steel fabrication, machining, precision manufacturing, and also these wear parts and consumables which are needed to use these parts. So we are saying that from 9,000 tons, we will be able to manufacture up to 18,000 tons, which includes these wear parts and consumables which are needed to manufacture these large industrial items.
Okay. Thank you so much and all the best.
Thank you. Thank you very much.
Thank you. Is there no further questions from the participants? I would now hand the conference over to Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers Limited, for closing comments. Over to you, sir.
To conclude, I believe Q1 FY27 has provided a strong foundation for the year ahead. The combination of healthy revenue growth, resilient profitability, and a 209 crore order book, expanding manufacturing capacity, and a diversified opportunity pipeline gives us the confidence in our ability to sustain the growth momentum. At the same time, we remain conscious of the external environment and will focus on execution, operational efficiency, and prudent financial management. Our vision is to continue evolving Diffusion Engineers from a specialized welding and wear protection company into a broader integrated engineering solutions provider, serving India's and the world's critical industrial sector. I would also like to express my gratitude to our dedicated team members, valued clients, suppliers, bankers, and all our stakeholders who continue to place their trust in us. We remain focused on delivering sustainable and profitable growth and creating long-term value for our stakeholders. For any further information, please feel free to connect with our investor relations team. Thank you and have a great evening ahead.
Thank you. On behalf of Diffusion Engineers Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.